Hello, Jeremy Finger here, certified financial planner with Riverbend Wealth Management. I have on the call today, or the video today, Malcolm Polley. He's chief market strategist with Stratos Investment Management. They manage, I guess, so close to $2 billion. Is that right, Malcolm?
Billion seven right now. Yep.
Billion seven. That's right. And so he was featured in, or he was mentioned in the book Too Big to Fail. So a little bit of claim to fame there. And as you can tell by his looks, he's been in the business quite a while. And I think you had an ominous day of starting. Is that correct?
That's right. I started on Black Monday, 1987.
Right, right. The Dow Jones went down what percent that day, roughly?
About 27%, I think, was the
In
number.
one day. Wow,
Yep.
big ones. Yeah. And I think consequently that Tuesday was probably the biggest rally ever as a percentage too.
Yeah, I mean, people pointed it as a bear market, but you basically got back to where you started by year end. So very short-lived bear market.
Yeah. And I think we've probably experienced that about 4 years ago as well.
Yep.
As well. Yeah, big down and big up. So all right, Malcolm, welcome to the show here. There's been a lot of talk about, market valuations and interest rates. What do you see out there as the biggest hot button right now that people need to know more about?
Yeah, I think the biggest question mark right now is when or if the Fed is going to cut short-term rates. I mean, it's kind of interesting. A year ago, basically, everybody was still on the bandwagon of higher for longer. And somewhere between a year ago and the year end, the market switched, and maybe it was because of the Powell pivot back in December from higher for longer to we're going to cut six times. Well, I always thought that was kind of silly. And so our base case at year end was okay, if they cut, maybe second half of the year, maybe twice. Um, but my biggest concern as I look at the market today is the market's still betting on Fed rate cuts. I mean, it's not a matter of if, but when. And I know it keeps getting pushed out. I think that a lot of folks are really now focusing on maybe September as the first cut. But the market's still really hanging its hat on lower short term rates. And in my mind, the biggest concern that I have is what if the Fed decides not to do anything? And that's because if the market is really hanging its hat on Fed rate cuts, if the market doesn't do anything, if the Fed does not do anything, then all of your assumptions on valuation, all of your assumptions on growth and earnings, et cetera, have to change. And higher rates, all else equal, means lower values. Um, and I guess that's my biggest concern is that the Fed doesn't cut this year. That doesn't mean they won't cut next year, but they don't cut this year.
Well, let's say they don't cut. Let's say your prediction is correct. What would that mean for valuations?
Well, you saw the kind of the reaction when the Fed kind of made mention of that fact at their last release is that, we think we're going to have to hold on. And in fact, it's kind of interesting. If you've been listening to the Fed all year, the Fed has been very consistent in saying we are data dependent. We want to see inflation come down. Inflation looks like it's coming in too hot. And whether you pick your choices, the PCE, which is the personal consumption expenditures deflator, which is the Fed's preferred measure, or CPI or PPI or wage growth, it's all been reasonably hot. So if the Fed doesn't cut rates, then I think that our belief has been all along that the yield curve continues to normalize. And what people don't seem to remember is that a normal yield curve means longer rates higher than shorter rates.
Yeah.
An upward sloping yield curve, which we haven't had in 2 years. That means that cost of capital rises across the curve, which means all else equal, values have to come down. And that's my concern, is that if values have to come down, that means values across the capital spectrum, not only bonds, but stocks as well, probably need to reprice downward, which is why we've really been upfront in saying we think that investors need to focus on shorter duration assets. Now, notice I didn't say bonds because that's been our focus for a while. But stocks have duration also, and duration really speaks to volatility relative to interest rate moves. So if you have a duration of 4, for example, and interest rates rise by 1%, then the value of that asset will drop by 4% and vice versa. So it tells you how much your asset value will move based on a 1% change in interest rates. So lower duration equities are things that have earnings, have cash flow, might pay dividends. And that's why at the beginning of the year, we said, look, you need to focus on the other 493 names in the S&P 500, not the Magnificent Seven. And it's been interesting because that Mag 7 is down onto the Mag 4 or 3, because several of them have not done that well this year. And that could continue to be the case as we work through 2024, as we get to see away from the extreme top end of the market capitalization spectrum toward those that perhaps didn't participate as much. And that's where we've been continuing to look in terms of adding things to our portfolios.
Okay. All right. So, and can you give us like a little bit of a recap on duration? Now, obviously, the people who are listening here are in the top 1% of intelligence, right? Otherwise, they wouldn't be here, right? Wink,
well,
wink.
And duration is a concept that even professionals have a difficult time with.
Is that right?
Many people confuse duration with maturity. And while they're related, duration really, in the way it's used in the markets today, has to do with volatility in the face of interest rate changes. And that's what we're really ultimately concerned with.
So,
right?
so what would be something that considered shorter duration then? If in the area, so give us some examples. You said, so it doesn't necessarily have to be bonds. So give us an idea of what you're talking about.
So if we look at stocks, for example, a longer duration stock would be something that doesn't pay a dividend and doesn't have earnings, perhaps. So Tesla, for example, would be longer duration than a utility stock, which pays a high dividend.
Okay.
That's not me saying it makes sense to buy utility and sell Tesla, but that's just the differential. So
this is informational purposes only. These aren't investment recommendations.
Exactly.
And my compliance office is going to love that I said that. Right. So that's good.
So high dividends, all else equal, has a lower duration than low or no dividends.
Because you're getting some of that income now. All right. With that being said, so if you're thinking about this information and that, well, we may be in a more normalized yield curve and lower duration might be better. Are you guys tilting y'all's portfolios typically toward that direction, those lower duration?
We have been.
Okay.
Across the spectrum. And we've really also been trying to add things to our portfolios to protect against downside rate moves. So in many of our asset allocation portfolios, for example, we have added allocations to hedge funds to provide some of that downside protection. Because in a rate environment that is moving at worst opposite to what the market's expecting, or at best maybe not as much as the market is expecting, you get a lot of volatility. And so you want to try and reduce the downside volatility or the risk of loss in your portfolios to the extent you can, because ultimately it's not how much you make, it's how much you keep, right?
Yeah, that's right. Yeah, you can double your money, but if there's a 90% tax on it, you're out of a lot of it. So, yeah, that makes a lot of sense. Yeah. So you've been tilting it. So hedge funds, and a lot of times what people don't. I just talking to a CPA today. Yeah, he says, we were talking about a particular client. I said, yeah, like most clients, they tend to want to take on more risk when things go up. They want to take on less risk when things go down.
Right.
Yeah, which is almost the kind of opposite of what you want to do.
But that's kind of, if you think about it in terms of investor psychology, that's pretty normal, right? everybody loves it when things are moving up, and we tend to have performance envy. So you go around, talk at the coffee shop or what have you, so my portfolio is up 40%. Well, mine's only up 10. Well, what's the difference? Well, it could be that, well, the person that's up 40 is 100% stock and the person that's up 10 is only 30% stock. Huge
So
difference there. And you
yeah,
should expect performance differences. So, the first thing I've always tried to tell people is don't have performance envy. Don't look at your performance relative to what your neighbor is doing, but look at your performance relative to what your goals are.
that's right. And look, that's what we do.
Yeah.
Yeah, absolutely. That's why we do the full planning picture, the holistic type of planning. So okay, so hedge funds, one thing is that like you're trying to invest in things that may be able to give you a return in volatile markets. Is that
Yes.
kind of what you're talking about?
Give you a positive return or reduce the downside potential in your
Right.
portfolio.
And that's one of the kind of your investment philosophies is if you want to get some upside, but you want to be get risk adjusted returns.
Exactly.
Right.
I mean, I teach periodically in a local university, and I really view a lot of what I do as teaching anyway. And it's what I tell people is that, people focus so much on the return side as they forget how much risk you have to take to get some of those things. And, even in asset allocation guidelines, people say, okay, I need a 10% rate of return, but if you're going to do that, you have to be 100% equities. And so you need to be very much weighted toward that. And you have potential downside, the volatility around a 10% rate of return or standard deviation, if you will, how much it moves around that average. You could potentially be down 16% or up 16%, right? So,
Big swings.
yeah, I mean, is that something the average person is comfortable with? And my guess is the answer is probably no, but
Yeah.
people lose sight of the risk side of the equation.
Yeah. They say yes when tend to say yes when things are going well, and they tend to say no when things are going poorly.
Right.
Yeah.
It's interesting. I did, and this goes way back at the end of the 90s, I did a survey of clients at the place I was working at the time. And I was I was asking people, what do you think the long-term rate of return on stocks is? So you have to remember, from a context standpoint, 1999, you had things 3 straight years
Everything
of
was going up straight up.
double-digit equity returns.
Oh yeah.
And so
Huge.
I asked people, what is the normal return on equities? And about 80% of people said 20%.
I know. Another truth.
That's a great example. If things are going really well, everybody assumes that's normal.
Oh man. It's funny, Malcolm. I kid you not. That reminded me of a story. I had a client of mine at the time because guess what? I was a financial advisor in the 90s, believe it or not. Um, and he says, I'm kind of conservative. All I want is 20%.
Yep.
that's, that's, that's so
But if
it's
you kind of
scary,
roll that
but
back, if
funny.
you kind
What's
of roll
that?
that back to today, you hear a lot of people say, well, interest rates are really high. Okay, relative to what? If relative to the last 10 years, well, yeah. But the last 10 years were an historical aberration. I mean, you don't go with 0% rates for a long-term period of time. But if you look back through most of my career, a 4% 10-year is very low. Average 4.5%, 5%. Fed funds at 5.25. Yeah, it's a little above average, but long-term average again is about 4.5%. So relative to normal, it's about normal. And we
Okay.
just have lost our frame of reference.
All right. Understood. What about like inflation though? Like I was talking to someone today and he and a friend of his spent like $28 with two combo meals at a fast food place.
Yep.
All right. So, well, like, well, what's pushing inflation higher,
Mm-hmm.
and what's the expectation going forward?
Um, well, there's a long-winded explanation in my mind. You get a lot of different arguments. So you have the monetarists say, money supply grew very rapidly, particularly in COVID, which is really pushing rates higher, and you need to pull that money supply back. And
Okay.
that's true to a certain extent. you've got people saying, as I have, you've got a lot of some dislocations that are driving things higher. So the war in Ukraine, for example, Ukraine was the third largest supplier of foodstuffs in the world prior to the Ukraine war. Well, a lot of that's been taken out of the supply chain. Russia was one of the largest suppliers of natural gas in the world. You've taken a large chunk of that off the market. So you do have some supply dislocations. Excuse me a second. You do have some supply dislocations. But I also think part of the problem is demographic, which is one of the things I'm in the process of doing a piece on to explain that demographics has a say in it. So why do we have healthcare inflation, for example? Well, the average baby boomer is 69 years old. As you age, your utilization of the healthcare system goes up because, as I can contest, your body doesn't feel as good as it did when you were in your 30s. Right? So
Yeah.
you might take more medication. You might have body parts like knees and hips replaced. You might have to get a hearing aid. There's just a lot of things that go on. And you might get sick more frequently. It's just as you age and you got the baby boom generation, of which I'm the tail end, utilized a lot of things as they worked their way through the demographic world. And so right now, their biggest impact is on healthcare, for example. Well, now you've got the largest generation in history now in terms of numbers of people, and a generation that will be the second largest generation in history in a few years. So the millennials, which are the largest generation in history, and Gen Z now entering the labor force. Millennials are all there. Gen Z is now entering the labor force. Big demographic push at the highest earnings rate increase and highest spending rate increase in their lifetimes. Much like the boomers, but probably at a lesser degree, is all demanding stuff at the same time, and and you don't have the supply. Housing's a perfect case in point. If you look at where the biggest price demand mismatch is, it's at the first time home buyer. I was just talking with a realtor the other day, and she says, you can't keep those first time homes on the market. And if you can get them on the market, they're probably priced higher than the average person is able or willing to spend because there's so much demand. And that, I think, is also pushing inflation. So I think there's some natural demographic flow to it that's going to mean inflation is higher than we would like it to be or would expect it to be. In fact, my belief is that the Fed's goal is 2% inflation. We're not going to get there. I don't think 2% is a realistic number if you want to maintain an economy that's growing at least a modest pace. I think in order to get to 2%, the Fed's going to have to do things they're just not willing to do. And so that's kind of my base case. Inflation doesn't get as low as people think. And there's a lot longer explanation to why that probably doesn't make sense, but we're probably limited in our time and scope here.
Well, yeah. Well, you did bring up one thing about adding money to the economy because a lot of money was pushed into the economy back in COVID. Are they taking money back out?
Yes, and taking money back out in terms of savings.
I mean, I'm talking about the Fed. Are they tightening in some way or trying to pull money back out in some way to help stem inflation? You're talking about the monetarist talked about. Yeah.
Yeah. So you've got kind of two pieces to that, right? You've got the monetarist side, money supply. You've also got the fiscal side of it. You've got fiscal restraint from the simple standpoint. Under Keynesian economics, you can cause economic growth by increasing the deficit and spending more money. But what people forget is it's not the size of the deficit, it's the size of the change in the deficit. So massive change in COVID and things have leveled off. So that delta, that rate of change is basically zero now. That's restrictive. It's not an expansionary, it's somewhat restrictive. Now, will Washington cut spending? I don't think it's in their DNA to do that.
Yeah.
Maybe they might in certain areas, don't know. On the other side, the Fed has really two areas that they need to look at from a restriction standpoint. One is quantitative tightening, which is reducing the size of their balance sheet because they bought an enormous amount of debt in order to push down longer term interest rates, particularly during COVID. And so the Fed has been doing that. Now, what the Fed did in their announced at their last meeting is they're going to reduce the scale and size of their quantitative tightening, but it's still tightening. Okay. The other thing that they could do is, again, higher for longer, maintain interest rates at a higher level than they otherwise might, which I think, again, if you listen to what the Fed is saying, inflation is a concern of theirs. They probably make sense to them to maintain rates at a higher level than they would otherwise have liked to do because they're concerned about inflation. So I think the long-winded answer to that is, are they taking money out of the economy? In the best way that they know, they're doing it in the best way that they know how without creating a major dislocation. In other words, a big full-blown recession.
Yeah, and they don't want to do that. Now, another point that you made, you're talking about an inverted yield curve for a couple of years, and typically it does lead to a recession. And we
it has, but it doesn't always.
Yeah.
If you really think about what the shape of the yield curve tells you, it tells you what people's and investors' expectations about future interest rates are going to be. And it is true that interest rates generally follow economic activity and inflation. But again, not always. And it could just be that the market is saying interest rates in the future are going to come down. Not as much today as it was a year ago, but interest rates are going to come down a little bit in the future. If you've got, for example, a 3% rate of inflation and a 4% or 4.5% bond yield, you've really got a 1.5% real rate. That's the bond yield subtracting inflation. And that's not overly high and it's not really low. It's okay. So I think really what the market is telling you right now from a yield curve perspective is that interest rates might come down a little bit, but not necessarily that much, which kind of goes along with what I've been saying.
Yeah. Okay. What else is out there besides interest rates, although that's a big one, and inflation? That are
Well, we are in the midst of political silly season right now.
No, say it's not.
You haven't seen any commercials on TV for your
No,
congressman
I've
or
single-handedly
senator.
blocked about 1 billion numbers. They
Yep.
send me these random texts and I go delete and block.
Yep.
But I think there's probably only 5 numbers available in the United States today. Based on yeah.
But
So,
that's another big issue. So it's a matter of, okay, who's going to be president? Who's going to run Congress? What kind of policies are they going to implement? And how is that going to impact me, or how is that going to impact the economy? And I think right now, the big unknown is you don't know. As of right now, the polls are pretty tight. It looks like Trump is leading. Don't know how that's going to play out through the course of this election season. There are a lot of things that make it look like Biden is not campaigning as aggressively as some people would like. I have to admit, I'm not overly surprised by that. It worked in 2020. Why wouldn't it work again? I mean, he basically campaigned from his basement in 2020. But what kinds of policies will those various administrations put in place? And if you're looking at a renewed Biden presidency, I guess the fallback on it is whoever gets elected is going to be a lame duck because that's their last term in office. But if it's a Biden presidency, I think you see more of the same, where the FCC continues their push on trying to tamp down mergers and acquisitions because of anti-competitive reasons. Don't know how real. I don't know that that's very realistic, but that's what their push that they've been doing. If a Trump presidency comes into play, do you get more tariffs, which is itself somewhat restrictive? and reduces the potential economic growth. So I think the fear, regardless of who becomes president, is that the administrative policies tend to be somewhat less growth oriented than might otherwise be the case, and which could tamp down growth, which might mean 3 or 4 years of blah.
Yeah. Okay. Any thoughts on sunset provisions that are one way or another with whichever president?
Well, the Trump tax cuts, I believe, sunset in 2025.
The end of 25, yeah.
And so will they sunset? A lot of it depends on who's controlling Congress and who the president is. If Trump wins the presidency and Congress moves to the Republicans, then you have a better than even chance of them being pushed out and maintained.
Yeah.
If Biden wins the presidency and the Democrats retain control or maintain control of one chamber of Congress, you probably have a good chance of those tax cuts actually sunsetting.
Yeah.
Which again is not pro-growth.
Is not pro-growth. Yeah.
And the biggest impact probably goes to estate tax, which right now I apologize for being wonky. The unified credit is you got 11 million per spouse, so you got a $22 million unified credit. So if you're
a little bit more than that now, it's a little bit more.
So, but it's just nice round number in my head.
Sure. Yeah.
So say roughly $22 million. If your state is 22 million or less, you don't have to worry about estate taxes. Well, if those sunset, I think it goes back to $1 million a piece. That's a big gap.
Yeah, I think it goes down not quite that much.
5 million a piece.
Yeah, something like that, maybe 6 or 7. But in any event, it's
10
a
or
big
12
number.
million to 22 million is a huge difference.
It's a big difference. You're looking at 40-50%, and we're very rough on the numbers, Mr. Compliance Officer. All right, just in general, there is a reduction in the amount of the unified credit. Okay.
Yes.
So so check with your financial advisor and your tax attorney.
Yes.
Yeah, that's right. Okay. So we talked about interest rates. We talked about inflation. We talked about Tax Cuts and Jobs Act. We talked about, how to be a little bit more defensive in times of, what we're in right now.
Mm-hmm.
We talked about the silly, what'd you call it? The silly
political silly season.
Political silly season. I like the way that's funny. Anything else top of mind for you guys?
So I guess the question people say is that I've been getting is, and I got to think, is there any positive stuff out there? And I think there is. And I think there's a book out there that's called "There's a Bear Market, always a bull market somewhere." And I think that not everything is bad and problematic. We really say we are worried bulls. We are bullish on equities. And I think that there are good values to be had and there are good investments to be made. It's just that we have to be a little more forward-looking in how we look at investments. We can't just say, oh, in general, things are going to be great, go whole hog. You have to be a little more specific on what you're trying to do and understand that there are risks involved. But there are also some things that you can invest in that are going to be just fine 3, 5, 10 years down the road, which ultimately is where we should be looking. Should we concern ourselves with next week? Yeah, possibly. But over the longer term, next week's just noise.
Yeah. Perfect. All right, great. Malcolm, thank you very much for your words of wisdom there, sir. Appreciate it.
Thank you, Jeremy.
Yeah. And by the way, if you get any questions or comments, certainly feel free to reach out to us at Riverbend Wealth Management. Well, thank you, Malcolm, and have a great week.
You as well. Take care.